Hello everyone, welcome back to another lesson, and today we're going to be talking about indices or indexes. We're going to be talking about the S&P 500, NASDAQ, and the Dow. And before I get started, I think I'm going to just raise a question real quick. You probably heard this a lot, but some people say that the market's up or the market's down. And you might think, what is the market? And in this lesson, we're going to answer exactly that because the market can actually have multiple different interpretations. So without further ado, let's talk about what exactly is a stock index. A stock index takes the groups of stocks and turns their combined performance into one number. That saves us from having to check hundreds of different companies one by one because we can just use this index to do that. So let's say an index goes up 1% today. That does not mean every company in it went up percent, but the average of all the companies went up 1% total. So some stocks may have risen a lot, some may have barely moved, others may have fallen. Regardless of what happened, the average was 1%. The index basically gives you a summary of what happened to the group overall. There's also another important part about this. Not every stock has the same effect on an index. Some companies may have more weight than others, which we're going to get a little later in this lesson. Just the key idea is different companies play different roles in indexes depending on how the index is actually structured. So for now, just think of an index as a quick way to check how a group of stocks is actually doing. Now, why do people actually use indices? Indices are useful for several reasons. The most obvious one is just communication, right? Imagine trying to explain what happened in the stock market by listing the performance of hundreds of different companies. That would be useless. Apple, 2%. Nvidia, 2%. I don't know, Tesla, minus 2%. Like to thousands of thousands. It doesn't make any sense, right? Instead, someone can just say that the S&P rose today, and you immediately have a rough idea of how large US stocks performed. Indices are also used as benchmarks. A benchmark is something you compare your own performance against. 8% by itself does not tell you much. If the S&P gained 3% during that same period, your portfolio did better than the benchmark, right? You performed 5% more than what the benchmark did. If the S&P however gained 15%, your portfolio actually did a lot worse. Indexes also give index funds something to track, which we'll cover later in this lesson. Let's talk about a very common index called the S&P 500, and you probably heard this before. It tracks 500 large US companies from different parts of the economy. Because it covers hundreds of companies, people use it as a broad measure of large US stocks. The S&P 500 is also market cap weighted. This is key. Remember, market cap is the share multiplied by the shares outstanding. So, in the S&P 500, a larger company has more shares and also has a higher share price, would have more influence on the index than a smaller company. If one of the largest companies in the index makes large moves, that can have a much more noticeable effect on the entire S&P 500 than if a small company would do the same thing. That weighting system is an extremely important part of understanding what the S&P 500 is actually measuring. So long story short, top 500 large US companies, and it's weighted by how large they actually are. Next, the Dow Jones Industrial Average. The Dow is a much smaller index. It only contains 30 large US companies. You still hear about it pretty constantly in financial news because it's also a very well-known index. But the way the Dow is built is a little bit stranger because the Dow is actually price weighted. That means a stock with a higher share price gets more influence in the index, right? But remember what we learned a few lessons ago. Share price does not tell you how large a company is. So this is pretty interesting, right? Because the Dow Jones ranks it by share price, even though that's not an accurate representation of how much the company is worth. So a company trading at $300 per share is not automatically bigger than a company trading at $30 per share, but that $300 per share company will have a way larger influence on the Dow than a $30 share per company, even though the $300 company might not be bigger than the 31. That is why the Dow's weighting method can sometimes give higher price stocks more influence when the company is smaller by market value. So the Dow is pretty good, important worth knowing, but just long story short, it's a narrow picture of the S&P 500. Next, the NASDAQ Composite. Again, this one's also different. It includes thousands of companies that are listed on the NASDAQ exchange. So, by company count, it is much larger than either the Dow or the S&P 500. Like the S&P 500, the NASDAQ is also market cap weighted, so large companies have more influence, small companies have less influence. Another thing to know is that technology companies make up a large part of this index. This is why, as you'll often hear people describe the Nasdaq as tech-heavy. If large companies have particularly strong or weak day, you may see a noticeable effect on the Nasdaq composite just because it's mostly tech companies. So, even though the Nasdaq contains thousands of companies, the largest companies still matter a lot because of the market cap weighting system, right? Large companies have more influence, and vice versa. So, we can look at all these three different indices side by side. The S&P 500 has 500 large U.S. companies. It is market cap weighted and is commonly used as a broad benchmark for large U.S. stocks. You probably heard of it before. The Dow, however, only has 30 companies. It is price weighted, and it's also, which makes it different from the other two, right? Because both are S&P 500 and Nasdaq Composite are both market cap weighted. This one's price weighted. The Nasdaq Composite has thousands of Nasdaq listed companies. It is market cap weighted and has a much heavier technology exposure. So all three track stocks, but they're not all interchangeable just because they have different structures, different tracking methods, different companies, different number of companies, and different ways to actually weigh those companies, right? Either price or market cap. Now let's actually talk about how weighting actually works. An index needs some rule for deciding how much each company counts. In a market cap weighted index, larger companies get more influence because their total market cap value is larger, right? That is the method used by the S&P 500 and the Nasdaq Composite. The Dow uses price weighting. There, the actual price of one share determines how much influence the stock has. So a higher priced stock gets more weight. This may sound like a technical detail, but it actually changes how the index moves because it's extremely important, right? Different companies have different influence on the stock. They're not all equal. If you want to track it, if you want to have an index that's equally weighted, then just find one, right? Equally weighted means every company has the same exact effect on the index. The Nasdaq, the S&P 500, and the Dow Jones does not have equal weighted. It's not equal weighted, market cap weighted or price weighted. So, two indexes can contain similar companies and still behave differently because they give thousands of companies different amounts of influences. Now let's look at an example real quick to further strengthen this topic. Let's say we have Company X and Company Y. Company X trades at $300 per share, and it's a pretty small company. And Company Y trades at $30 per share and is 10 times larger by market cap. Now, let's put these companies into a price-weighted index. Company X has a $300 share price. So this company, Company X, will get larger, more influence than Company Y. The index cares about the share price, right? Now, put the two companies into a market cap-weighted index. Company Y gets a lot more influence because the company itself is much larger, right? 10x larger than the Company X. Nothing about the companies actually changed. It's just that the weighting rule changed. And we got the opposite result. In one index, has more influence. Another index, this is more influence. So this is why you need to know how an index is actually built before you can fully understand what its movement actually means. Why is the S&P 500 a common benchmark? Why couldn't it be any other index? Why is this one the common benchmark? The reason why is it covers far more companies than the Dow and weights them based on company size. This gives investors a useful reference for how large U.S. stocks performed over the majority of the U.S. markets. So suppose your portfolio gained 5% over a year and the S&P 500 gained 10% over the same period. Your portfolio underperformed the S&P 500 by a lot, right? And if your portfolio gained 12%, you would have outperformed it. That does not automatically tell you whether a portfolio is good or bad. A benchmark is just a comparison point, right? So you still need to think about the things like the types of investments being held and how much risk is being taken. But without a benchmark, you do not have much context for the return. That is why the S&P 500 is a common benchmark, because your portfolio has to be compared to something else. 1%, who knows what 1% means, okay? You made 10% in a year, right? That sounds great. But hypothetical, what if the S&P 500 made 12%? Then you should have just bought the market than trading your own portfolio. Just doesn't make any sense, right? That is why the S&P 500 is a common benchmark, because it tracks the 500 U.S. large companies, which makes up a large portion of the U.S. markets. Now, here is a pretty important distinction here. You do not buy the index itself. You can't buy the S&P 500 itself. The S&P 500 is just a calculation, right? The same is true for the Dow and the Nasdaq composites. These are just measurements. They're not actually stocks. When someone says that I invested in the S&P 500, it usually means that they bought a fund that tracks the S&P 500. An index fund or an ETF can hold the stocks in the index and try to follow its performance. right? So keep these two ideas separate. An index is the measurement, right? The measurement of whatever stocks it has. The fund is the product that an investor can actually buy, and it tracks the index. We will spend a lot more time on funds diversification later, but just a key idea right now is you have to understand that distinction. Now, you can try it on Google too. I have a picture here. I tried it. You can literally just look it up, look up the S&P 500, look up the Dow Jones and Nasdaq Composite, and just look at the percentage change. Maybe one's up, maybe one's down. Just go ahead and take a look. It's all on Google, all public information. So, let's take a look at another common mistake. One common mistake is avoiding treating the market like it's the exact one number. It's not. The S&P 500, the Dow, and Nasdaq Composite can all have different returns on the same day. Sometimes the differences are pretty small, and sometimes they can be a lot larger. That can happen because, as you probably already know, these different indices hold very different companies. Well, not very, but somewhat different, right? And different amounts of companies. So, if one part of the market is moving a lot, an index with more exposure to those companies may react more, right? For example, technology moves more, NASDAQ reacts more, right? So, when someone said that the market was up 2%, it's pretty important to ask what index, the 500, the Dow, or NASDAQ, right? That little question can actually make the statement much more precise because the market is up 2% is ambiguous. Multiple different interpretations, S&P 500, Dow, or NASDAQ Composite. So, let's go ahead and recap, a summary. The main idea is pretty straightforward. A stock index combines the performance of groups of stocks into one number. The S&P 500 tracks about 500 large US companies and uses market cap weighting. The Dow tracks only 30 companies and uses price weighting. The Nasdaq Composite tracks thousands of Nasdaq-listed companies, uses market cap weighting, and has a large technology influence. The weighting method matters because it determines which stocks have the most effect in the index. And remember, you cannot buy an index itself. You have to buy a fund or an ETF that is designed to track one. So, whenever you see the news, the headline, right, pretty common financial news, the market rose or fell, you now know what to look for. What exactly rose or fell? Which index rose or fell? Now, I hope you enjoyed this lesson. I hope you learned something new, and I'll see you in the next one. Bye-bye.